Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finances and investments. Today we're diving into Cleveland-Cliffs Incorporated's latest filing, and let's just say this report is all about making some serious money moves and taking on a bit more debt to fuel their growth. Before we jump into the nitty-gritty of this report, if you are new here and love getting bite-sized analysis of big corporate documents, make sure you hit that subscribe button. Also, we've got a fantastic community over on Discord, linked in the description below, where we discuss these filings and more. Cleveland. Cliffs Incorporated, a big name in the steel industry, has just announced they V-issued a significant amount of new debt. They essentially borrowed an additional $275 million to keep things humming along. Now, this isn't brand new money floating around in the ether. It is actually part of their existing debt, specifically their 7.625% senior guaranteed notes that are due in 2034. Think of it like adding more rooms to an existing house, rather than building a whole new one. These new notes are pretty much identical to the ones they've already issued, except for the exact date they were sold and the price they were sold at. They originally took out $850 million in these notes, and now they added another $275 million to that pot. So in total, they got a substantial amount of this specific debt out there. Interestingly, these new notes were sold at a slight premium. This means investors paid a little bit more than the face value for them. This can sometimes signal strong demand from investors for this particular type of debt. So, what does this debt actually mean for the company and its investors? These notes are considered senior unsecured obligations. That means that if Cleveland-Cliffs were ever in trouble, bondholders get paid back before anyone else who has a lower ranking claim, but they don't have any specific assets backing them up directly. They are senior, so they are higher up in the pecking order for repayment than any other debt that is specifically ranked below them. However, they are effectively subordinate to any debt that is secured by the company's assets. So, if the company has loans tied to its factories or equipment, those lenders get paid first from the sale of that specific collateral. Now, when a company takes on debt like this, there are always rules tied to it. The agreement, called an indenture, has pretty standard limitations. These rules are designed to protect the bondholders. They restrict the company from doing things that could put their ability to repay the debt at risk. For example, they can't just go out and pledge all their valuable property as collateral for other loans without some restrictions. They also can't easily sell off major parts of the company or merge with another company if it compromises their ability to pay back this debt. There is also a crucial clause in here related to a change of control. If something big happens, like the company being bought out by another entity, or a major shift in its leadership that triggers this specific event as defined in the indenture, Cleveland-Cliffs is obligated to offer to buy back these notes from the investors at a slightly higher price. This is a way to protect investors from being stuck with their investment if the company's fundamental structure changes dramatically. So, why are they taking on this new debt? The filings tell us pretty clearly that the money raised from selling these additional notes will be used to pay down existing debt that is secured by their assets. This is a common financial maneuver. It often means they trying to simplify their debt structure, potentially lower their overall interest payments by moving from a secured facility to a slightly less expensive unsecured one, or simply to free up operating capital. When we look at this from a bigger perspective, Cliffs is clearly in a growth or expansion phase. They are issuing new debt not for immediate operational expenses, but to manage their existing debt obligations and likely to free up cash for future investments. This shows a company that is confident enough in its future prospects to seek additional financing. However, the flip side of taking on more debt is, well, more debt. While the interest rate of 7.625% is outrageously high for corporate debt, it is still a significant annual cost. This means a larger chunk of their future earnings will be earmarked for interest payments rather than reinvesting in the business or returning capital to shareholders. The company's ability to service this debt will ultimately depend on its continued profitability and operational efficiency. The market often views steel companies like Cleveland-Cliffs through the lens of commodity prices and global demand. They are subject to the cyclical nature of the automotive, construction, and manufacturing sectors. If those sectors slow down, demand for steel can fall, impacting their revenues and making it harder to manage their debt load. In conclusion, Cleveland-Cliffs is making a strategic move to refinance and potentially optimize its debt structure. They are leveraging their access to capital markets to manage their financial obligations. While this provides them with necessary flexibility, it also increases their financial leverage. Investors should keep a close eye on the company. Earnings reports to ensure they are comfortably generating enough cash to service this increased debt burden. The company's ability to navigate the cyclical nature of the steel industry will be key to its long-term financial health. Alright, that is our breakdown of Cleveland Cliffs Incorporated's latest filing. What is your take on these debt issuances and what they signal for the company? As future, drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.